let's start with 83B today. 83, what is 83B? The section 8. It's called a section 83B. It's of the tax code.
Yeah, so I'm going to zoom out even more and just go to section 83. So a section of the U.S. Code 83 relates to property transferred in connection with performance of services, right? So any property traded for services, right? Hey, come work for me. I'll give you company stock is the easiest one to think of.
So today's topic essentially is about stock compensation.
That's right. That's right. That's the context of property transferred for services under the tax code. And I'm by no means an expert in this. Contact your friendly tax attorney if you want to know like a ton of the history of Section 83. I know enough to say this is under this part of the tax code and get some guidance around that. But
let's get to this topic. Who should be worried about this?
Yeah, so the application of 83 in our context for today is mostly going to be under 83B. 83B is this election that you can make. It's a funny thing in the tax world. It's one of the only places I know of where there's no form associated with this. So there's no form 83B. This is just a letter that you write to the government and you say, I'm doing a Section 83B election on X, Y, and Z. And the purpose of it is acceleration. You're going to simply accelerate the taxation of a grant of options or stock, restricted stock that were granted to you, and you're going to say, look, I know this whole thing is 3 years long, 4 years long, 5 years long. I'm going to go ahead and pay all the tax owed on that today, right away. I'm going to accelerate this.
The big question I have about this is that, like, who does it specifically? Who should be concerned about this? Who are the folks? I mean, I can assume the typical person is like, I start working at a company, I receive a grant of, let's say, 8,000 shares, vested 2,000 of those are going to be vested at the anniversary of the first year. So like if I start working on a Wednesday, June 1st, the next year, or June 2nd, the next year, to be safer, is when, let's say, 25% is vested. And then after that, every month, a small portion is vested. Like, when should I be worried about that stuff?
There's only a subset of stock plans for which this applies. So the big one to think about that most people are going to get confused on is that restricted stock and restricted stock units are not actually the same thing. They work very, very similarly, but they're just not. So restricted stock units are very, very popular. If you work at a public company and have a normal equity plan, you probably have restricted stock units. It's very, very common. And you cannot do an 83B election with RSUs, but you can with restricted stock. Confusing point, I know. Read the documents, check and make sure. Ask HR if you're really confused about that. So that's the first one. So you can do it with restricted stock, but not RSUs. The second one is that in options plans, this does apply, but it only applies to early exercise, which is another piece of the possibilities in your plan that you need to be looking for within the plan documents.
So you need to ask your company or look at the plan documents whether you are allowed to early exercise.
That's right.
Right? Because for options, you don't own the stock yet. In restricted stock, you do own it, or you will own it, right? That's subject to vesting. In options, you have to exercise. Apart from like having to have it vested, you have to exercise it to own it.
That's right.
What's the benefit of electing an 83B? Let's say I got those 8,000 shares. My strike price is $1, just to make it simple. So I would have to pay $8,000 over the course of 4 years to, take possession of those stocks. That's if it's an option. Sorry.
That's right.
Right. So if it's restricted stock, it's vested, it becomes mine. Right.
That's right. That's right. You'd be a shareholder at that point. Yeah. So the big benefit, I like to call 83B 83 bullish, because fundamentally it's a bullish bet on your company stock. And it's going to be the most useful tool in your toolbox for if you're bullish on the price, the net asset value of the company stock. So if you're at a company that you think is performing really well, the market hasn't figured out how great it is, or you think is going to continue to perform, dominate the marketplace, whatever it is, whatever metric you have for determining whether you think your company is fairly valued, richly valued or not, an 83B is a bullish thing to do, because you're accelerating future tax into now. And that's only really beneficial if your stock price is increasing. It's most beneficial if your stock price is increasing. So if you look at this and say, when does 83B work best for you? It's when you're bullish on the stock and the stock price is going to go up over the course of your vesting period.
But let's say you're hired as head of product at an established company, and you're awarded let's say huge amount of shares, let's say, and you're hired there for like this. This is a company that's approaching IPO very quickly, that millions of dollars of revenue, and you know that the path, you're pretty much sure the path is an IPO within the next 2 to 3 years. And you're hired, and the day you start, you get that grant. You plan to exercise the stock within the next 4 years, and now you have, and assume this is an incentive stock options plus non-qualified stock options award, right? Because it's so big, the award, that it blew through the ceiling of the ISO limit that you can get. So they have to award you the extra non-qualified. We're talking about huge award. And so what should that person do in that case?
It will depend a lot on personal financial situation, caveat emptor.
Assume the person has this is like their third exit, or this would be their third exit. They're well situated. They could exercise everything. It wouldn't make a difference. Now, if the IPO happens, and it would make a big difference afterwards. But at the moment, the investment is not so big.
Yes, the clear answer that you're clearly setting me up for, so thank you for making it easy, is to early exercise some or all of these options at what we hope to be a lower current net asset value on those shares.
The one thing I forgot to tell you, mention, is that right now the fair market value is equal to exercise price, right? Because they have when they give you those shares, they usually give it to you when the strike price equals the fair market value. Right, that's kind of like natural default settings of options grants. If they exercise early, would they have tax on it?
Yes. Yes. So nothing, early exercise doesn't change the tax treatment of anything regarding your options. So your options are still going to be taxed in the way they would have been if you hadn't exercised early, other than the fact that you're chunking a bunch into one period.
Right. But if fair market value, isn't that the taxable gain, isn't it the difference between the fair market value of the stock at exercise and the strike price?
So in the case that you've mentioned, where strike price and stock price are the same. That's going to be a non-taxable event. So this is you've laid out the most slam dunk possibility on planet Earth for Section 83B, which is an option strike equals a stock price. You're super bullish. You've got the liquidity and the financial situation to go and do this. 83B is going to shine in this particular scenario.
Yeah. What I'm trying to say is the most applicable to any person is I'm coming in as a head of, let's say a team that's being formed for the IPO. I'm being granted a ton of shares. I'm here for the IPO essentially. And I'm granted a ton of shares. This is my third exit, my second exit. So it's not, I can afford this from my own wealth, to exercise. And that's why I think it's so valuable to just sit down with a financial planner and discuss the options. And this option is, to me, one of the clearest one forward. Everything else, when you start to complicate matters, it decreases the likely, I don't know what you call it, the going forward towards doing this 83B election. If you early exercise and don't file an 83B, you actually took away flexibility in your financial planning, future financial planning. You literally
you add there's no variability.
Yeah, very little positive there, because you would have paid the same amount to exercise a stock now or in the future.
Yep.
And you're not taking advantage of the whole tax situation. So the 83B, to make a successful 83B election, you have to first you have to inquire whether your company allows for early exercise. So you're exercising early the remaining amount of unvested, shares. You can do it. Remember, you can do it for stock options and restricted stock, not restricted stock units, as you said. Then, after you give notice to the company that you want to early exercise, they will explain to you what the process is. Usually, HR does that. Right after you exercise it, they should give you a pre-templated 83B election that you should send it into the IRS. And I don't know what the address is where you send it in, but it used to be Utah, I think.
Yep, Ogden, Utah. Yeah.
In Ogden, Utah. So like if you see the Ogden, Utah, you're on a good track, but maybe it might have changed. You need to send in that letter, and it's always good to call them up and confirm that they received it. When you send it in, make sure you send it in via what do you call that when you go to the USPS and say in receive a notification that mail. It was. Make sure you send it certified mail. Like that's like priority. Save that, scan it, take a picture on your phone, send it to your grandmother. Just tell them this is my path to rich. Make sure it's like documented in many places so you don't lose that. Because if the IRS comes back to you and says, "Oh, we never received it," you have evidence that you sent it.
Yeah, let me pivot to one more. The only other part of Section 83 that I know, which is 83I. 83I is a I would call it like a sister election, but it's kind of the opposite of 83B. 83I was meant to ease the burden of people who have private company stock that's vesting, who are getting hit with big gains on illiquid stock. So let's say you work at a late stage unicorn and you have RSUs in particular, you could use Section 83I to defer recognition of that income for income tax purposes for up to 5 years. This is a new thing as of the Tax Cuts and Jobs Act of 2017. I personally have never seen this actually be used in practice. And I've talked to other practitioners who agree and have never actually used this.
It's more like, hey, I joined very early on. I made a mistake of not exercising early with an 83B, and now I'm stuck here. I'm like poor. This is my first exit. Like 83I should come to your mind,
yes, right? Yes, exactly. So yeah, it's all about illiquid stuff, and it's also got this kind of mirror image piece with 83B where you can't use it on the same thing. So 83I you cannot use on restricted stock, but you can on RSUs, which is a little strange and counterintuitive. And then on options, it applies a little differently too. So on non-qualifieds, you can, but it's mutually exclusive with the 83B. So you really got to choose one or the other. And then on ISOs, you're going to lose your ISO treatment, so it's unlikely to apply.
I wonder though, because for the non-qualified stock options, if it applies there, it might be worthwhile to do it just for that, maybe.
It could if you've got a really big delta in your exercises there. It could be useful. And it's a 5-year deferral, but then the taxes are due in the year that this becomes liquid, right? So if you have a sale, an IPO, etc., that clock ends right at that point.
That year or that point?
Oh, good question. I'm not sure. It's a moving target of when this deferral ends. You really are not locking in a 5-year deferral at all. And also executives can't do it.
Oh no.
Executives are excluded. Yep.
How is an executive defined? Is it just CE something?
That's a good question. From my research, I show CEO, CFO, or their relatives. So maybe just be the top 2 executives.
That makes sense actually, because the 2 people who sign the 10Ks and stuff, I think it's the CFO and CEO, right?
Yeah, I think so. Did you see that there's I think it was the SEC chairman or commissioner was talking about reforming 10b5-1 plans last week.
More flexible or?
No, less flexible. So he wanted to reform the fact that you could cancel, like these, executives could put in these plans and then cancel them. So more rigidity around starting and stopping, and then a longer cool off period. So like you enter a 10b5-1 plan and then it doesn't actually begin for like 6 months, something like that.
But what's the other option? Selling in the regular, blackout periods? Sorry, non-blackout?
Correct.
Like a normal employee?
Right. Exactly.
Let's move on to the next topic, which is it's metrics. It's essentially investment metric, between stocks and funds. I think both of them have different metrics. They're related to each other, but I think funds have a different set of metrics, at least that I use to invest in them. And I want to say that in the world of investing, I would say there's three things I look at when I invest either in a stock or a fund. One is the underlying businesses or business itself. What is the margin? How much are they making essentially? How profitable are they? What is management's effectiveness in delivering returns there? So that is a good metric to use that is like return on invested capital. And what that metric is essentially, I think it's like supposedly net income over total capital, and total capital is defined both as, the equity that you have in the company plus the liabilities. So it's like total money used to generate a certain amount of income. And I think over the long run, I think it's like Charlie Munger said something very interesting where it says like over the long term, it's hard for a stock to earn a much better return than a business which like the underlying business earns, right? So the only way for you to do that is buying it at the very a tremendous discount. So not only are you getting the return of the company, but an appreciation of the multiple of the company of what it's worth. But there's a limit to that. So if the business earns 6% on capital over 40 years and you hold it for 40 years, you're not going to make much different than that 6% return. Even if you originally buy it at a huge discount over 40 years.
The stock return converges on the return on invested capital over time.
Exactly. So if you're a long-term holder of stock, then you ought to look at the return on capital. Like it should be a very important metric to look at. And unfortunately, in a certain industry, for example, the different sub industries in there have different kind of inherent margins because they have different pricing power. They have different, there's different competitive dynamics. So like in the coffee business, I think retail is a higher margin business than farming. Right, so farming is a low yield business, and retail, Starbucks, is a much better one. Although I think in the last 2 years, Starbucks hasn't done well because of COVID. Conversely, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you'll end up with one of a hell of a result. And so that's like the quote from Poor Charlie's Almanac. The other metric I use, is for valuation. And I use usually enterprise value over, I tend to use EBITDA. So enterprise value is, I believe, is like equity plus long-term debt or equity plus debt.
Minus cash, yeah.
Yep, minus cash, yeah. And then EBITDA is earnings before interest, taxes, depreciation, and amortization. And so it's a very quick and dirty way to see what you're paying for free cash flow, but it's
and in a scenario where you're analyzing a business and you're looking at EV to EBITDA, are you solely looking backwards, or are you trying to project both of those numbers forwards as well?
That brings me to the second point here. You actually like the perfect next step. Thank you for that question. It was highly relevant. So instead of looking at EBITDA right now, if there are Wall Street projections for the next 2 years, I would grab 2 years forward. And the reason is that so I can incorporate a little bit of growth in there. Right? So it's not technically only using like the past, it's using future projections. I usually tend not to do the projections, especially when there's like 15 or 20 analysts doing projections. Like you can look at the Wall Street Journal even, you can look at estimates in the future. And sometimes you can, I don't know if you can see it in the Wall Street Journal, but you can see how many analysts are predicting this. And it's like the consensus of all the analysts. So you have someone who's like estimates way higher, somebody who estimates way lower. Usually the group gets it right. The last piece is always like what I consider like a safety piece, which is, trading history. It's more like using it's other factors. It's more like competitive dynamics of the industry. I would group that together as externalities. I would look at like where the industry's going, where it's more of like the soft stuff.
Qualitative,
so those are three
macro things.
Yeah. And then you would try to look at like the competitors also, and you would try to rank who's the best. So the question is, how does this translate for funds? I think that's the next question.
Yes.
So for funds, it's easy, right? Because, if one company has return on invested capital, if you aggregate all the companies in that fund return on invested capital, you can get like an overall. And the higher it is, the better it is. Same thing with EV over EBITDA. Like the lower it is overall, the better it is. Some funds will have companies in there where the average return on invested capital is higher than the respective benchmark that they're following, and lower EV over EBITDA. So that's really positive. You're buying something better for less money. And then the industry growth, that's something I would actually read upon and try to find a kind of industry analysis of like how big the market is, how much will that company grow.
Would you look at something like EV to EBITDA of the S&P 500?
Yes, I would, because I want to know if I'm buying it cheap still or expensive compared to historic trading.
What do you think about the inverse of EV to EBITDA? So EBITDA to EV as like a correlation or as kind of a little bit of a proxy of like yield. So you can, the way I think of this is like, all right, there's a real estate building, I could buy it for $10 million and earned whatever, 700,000 a year. That's a 7% yield, right? And the EV to EBITDA is or EBITDA to EV is a little bit of a similar way to think of yield from a business that's a little bit more complex, has a more complex capital structure, more going on.
Yeah. So let's say how much cash you're gonna get, like the cash on cash return. Let's say how much how much you're gonna get from that real estate project. Let's say 6%. It's a valid way to compare EBITDA over EV, so the other way, and you get a percentage to the percentage of what you're getting from that real estate investment, and you can see technically which one will get you more. The issue also is that, remember that EBITDA over EV, that gives you a percentage. It's variable the same way that is variable your real estate. And remember what I said before is that over a long period of time, it trends towards the return on capital. Okay, so the return on capital and EV, EBITDA are not 100% aligned. It's not the same line items that we're using. One is using like the net profits. And EV EBITDA is using more like of cash to the firm before any interest, right? So one is using an unlevered, it's called an unlevered return, like an unlevered calculation, and one is using a levered one. So you just have to align apples to apples when you're comparing it to the real estate. What do you look in funds? How do you actually decide tactically which fund to invest in?
I'm usually measuring factors similar to what you've just described, and then I am trying to evaluate a little bit about the fund process. How are they arriving at what they arrive at? What does it cost to pay them to do this work? Do I think that the benchmark value is far exceeded by paying this manager to do X, Y, and Z type of work that they said they were going to do? So not tremendously different. I think what you've described fits pretty well into kind of a factor investor's mindset of like, all right, what are these big patterns that we can look at? What do they mean to us in terms of expected returns? And are they likely to be successful for us going forward? That's what I try to do.
This was all what we had to speak for today. So metrics and any 3B election.